You're listening to Southeast Radio's Business Matters with Karl Fitzpatrick in association with Wexford Insurances. Challenge us at Wexford Insurances 0818 31 30 30.
I'm joined in studio now by Paul Redmond and Jim Doyle of RDA Accountants based in Wexford and Kilkenny. Over the past few weeks, businesses have been fearing that statutory sick pay would be introduced in this budget. Jim, has this fear been justified?
Well, thankfully, Karl, this hasn't been introduced. It was widely discussed that employers would be obliged to pay their employees when they were off on sick leave. And so we're looking for some good news from the budget, and this is one of the areas, thankfully, that hasn't been brought in. Maybe a related area would be that maternity benefit now is going to be taxable from the 1st of July 2013, but otherwise there's no statutory sick pay scheme brought in for employers.
So what way will that work, let's say, for ladies out on maternity leave from July 2013, Jim?
They will have to now count their maternity benefit that they receive from the state or potentially from their employer. But maternity benefit from the state will now have to be counted as part of their income, which will be subject to tax.
And in relation to income tax in general, has there been any increase in the rates? No
increase in the rates, Karl, of income tax itself. The basic rate is still 20%. The higher rate is still 41%. There have been other changes, of course, to do with PRSI in particular, but the base rates are staying the same.
Again, lots of employers across the county, from the programmes that I've had over the last number of months, have wrote into the programme about their fear in relation to increases in PRSI. What are these?
Well, Karl, there's been substantial changes in PRSI. The first thing is for self-employed people, the minimum rate, the amount of PRSI that they have to pay in a year now has jumped. It's basically doubled from 253 minimum per year up to €500 minimum per year. So that is a big jump. It can be seen that for a lot of self-employed people, we would have many clients who are self-employed who maybe don't make a profit and maybe are not subject to income tax. In those cases, these people will have to pay a minimum PRSI payment of €500 in a year.
That's going to be a significant increase. Now, in relation to corporation tax, Ireland is known worldwide.
Well, you know, Karl, PRSI has been one of the really big changes in this budget. The government have broadened the tax base significantly with PRSI. They have got rid of the PRSI allowance, which effectively means that for some lower paid employees, it's going to mean an extra €5 per week of PRSI. They've also brought PRSI, made it applicable to unearned income. So this means that for deposit interest, there's effectively an increase in tax rate of 4% relating to PRSI, on top of the increase of 3% that they've added on to dirt tax. PRSI also now applies to dividend income. It also now is going to apply to rents for landlords. So a massive broadening on the tax base here with PRSI.
That's going to certainly have a serious impact on everyone across the country in relation to that. Paul, you mentioned to me earlier that it's going to have a serious impact as well on married couples in business. How's that going to work?
Well, Karl, if you have a married couple and they're working as a partnership in business and they're not making money, but they have to. They're very concerned here about the entitlement to their old age pension. I mean, a lot of people have said that to me, but people are paying the S rate of PRSI. The minimum contribution was €253, but if they're split as a partnership now, they could end up with a payment of €1,000, €2,500. Also, people with a PRSI, a person with a rental property, they're now ending up, they got a big shock this year with the USC. A lot of them ended up with tax bills where they didn't have tax bills before. But that's going to be increased now with the effect of the PRSI on unearned income, on the rental income.
Jim, we've seen in this budget there's been significant changes to redundancy payments and termination payments. How do they work?
Well, Karl, you know, this whole redundancy rebate for employers who need to lay off workers, up to very recently, if you were laying off a worker and you had to pay statutory redundancy to that worker, you would get 60% of the amount that you paid to the worker back from the government. In last year's budget, they reduced the rebate from 60% down to 15%, and now in 2013 they're saying that there's no rebate. So the impact of that means that any small business, or any business for that matter, who needs to lay off workers is going to have to figure out a way of being able to pay statutory redundancy without any rebate from the government. So this is a very, very big change. As far as I'm concerned, it's a disincentive to employ people in the first place because of the risk of potentially maybe having to make them redundant in the future. So a big change, Karl, and a step in the wrong direction as far as I'm concerned when it comes to employers taking on employees.
And what do you think the government's thinking behind this move has been?
My own thinking is that first of all, it doesn't seem like they're thinking about small business owners who can't afford to pay statutory redundancy. My thinking is that they're thinking of large organisations, perhaps multinationals, perhaps banks, who are laying off workers who perhaps maybe can afford to pay the redundancy. And so this is saving the government from having to contribute to that.
Adrian Toomey, employment law solicitor based in Enniscorthy, joined me on the show a number of weeks ago, Jim, and he said that he has clients across the county that can't afford to lay people off at this stage, even though they don't have to work for these staff. They can't afford to lay them off because of the structure of redundancy payments. Would you concur with that with your own clients?
Well, Karl, unfortunately over the last 4 years we've been involved in many situations where businesses and business owners have got into difficulty and have had to consider laying off workers. Now, laying off workers is a really difficult thing for somebody to have to consider, for an employer to have to consider in its own right. Normally, employers will leave it until the very last minute, until they're pushed into a corner before they'll even take an action like that. So what's happening now is that at least then they had a rebate of up to 60%. Now they've nothing. So it means that a decision that perhaps needs to be taken to allow a business to survive now is even more difficult to take, and in a lot of cases I see that this will put the business itself out of business. So I'm very, very concerned about this measure, and I don't see that it makes any sense. Now, if you can't afford to pay a redundancy payment, a statutory redundancy payment, you can get the government to pay it, and the government do pay it, and they have to pay it. But the liability stays with the employer, with the company who is employing it, or with the sole trader or partnership that was employing it, and that business owes it to the government, and the government can look to retrieve that from you at some stage into the future. So what I would say to employers, small businesses that need to lay people off that can't afford to pay these payments, it is possible to get the government to pay it, and it's something that you need to take proper advice on.
And in a related matter, we've seen the heading termination payments mentioned in this year's budget. What is that bringing in?
Termination payments is where an employee is leaving an organisation and is getting some sort of a lump sum from the employer. So you see this quite a lot at the moment, perhaps in the banks, where they're laying off quite a lot of workers, and they're getting termination payments. So this hasn't been touched for many years in budgets, but now they're looking to find ways of getting some tax out of these termination payments, because up to now it's been possible to get large amounts of termination payments without any tax deduction from those payments. So they are starting to bring a focus on it, look to take some tax revenue out of these termination payments. And as far as I can see, this really doesn't apply to small businesses, doesn't really apply to self-employed people. It seems to be an attempt by the government to find a way of being able to get their hands on some of the large termination payments that have been paid to some of these perhaps bank employees or senior executives that have been let go is from what I can see. So not a big impact for self-employed people.
There seems to be a real focus on the property investor on this year's budget. What impact is the budget going to have on them, Paul?
Well, first of all, the incentive is that there's a change in the capital taxes. So if somebody is sitting on a property and they have a gain on it, the tax rate is now 33%, the capital gains tax rate. The other big issue that people are having out there with regards to the property owners would be the introduction of the local property tax. There is confusion around, what taxes now are be payable on a property tax. The household charge will cease from January 2013, but the non-principal private residence charge will cease with effect from January 2014. But they're bringing in the property charge at 0.18% of the market value. It's incredible to try and figure out what a market value is. They're talking about bands and that you fall between a band. But if you fall between a band, you could be overvalued. So if your house is worth 110,000, you could be paying tax on between 100 at 125. So it's there, it's brought in. There is a bit of confusion around there. The rate will increase. If you have a house over €1 million, the rate is 0.25%. I don't know whether there's a lot of houses around my local area anyway that are over €1 million. So that's the property tax is here. It's here to stay. There's not a lot, we can't influence the property tax, but it's in. How we're going to pay it and the mechanism and all that will be brought in through the Finance Bill and the Finance Act. A lot of people are asking me now, how do I pay it, or what is the amount of this? So there is a scale rate on it, but as I said yet, we don't know what the amount is.
Jim, property investors seem to have been targeted in this budget. What are your thoughts on this?
Yeah, well, the property investor, a massive squeeze has been put onto the property investor. First of all, last year the USC was brought on to rental income. This year, from 2013, we're going to see PRSI now being applicable to rental income. We're seeing that this property tax is being payable by the landlord. Capital gains tax is increasing to 33%. Now, most of these landlords are already in trouble with the banks under mortgages on these properties. So I don't know where this money is actually going to come from. Because we have on the one hand now the banks trying to get as much money from these property investors as they possibly can, and they're all being restructured. On the other hand now the government and revenue want more money from them as well. The impact of this, I think, is that the quality of residential rental accommodation is actually going to disimprove. And so there's a disincentive there, I believe, for property investors to invest in property also. So I think this is bad for the tenant. I think it's bad for the property market, and I also think there's going to push more property investors who are already into trouble into even bigger trouble.
So, Jim, what you're saying is that at a time where the government need to look at stimulating the property market, it's going to have a negative effect on that.
There's no question in my mind that that's the case. It's an incentive now if you're renting accommodation, if you're living in rental accommodation, in my opinion, to stay renting, because you're not going to be liable for the property tax. So, yes, there will be pressure on the landlord to try and increase rents to try and recoup this, but I'm not sure that that's always going to be possible.
But we're effectively now paying property tax on a debt. There's a lot of properties are under water, so you're effectively now with negative equity. You're paying a tax on the debt. So people are just finding it difficult. It's another little amount, and the amounts, they're not massively significant at the moment. But the fear is, where are these going to? I mean, they're talking about bringing the collection of these now, of this property tax, to the eventually going to the county councils. So, I mean, we're moving to the systems that are in a lot of other countries, I understand that, but there's a fear of what will this actually get to at the end game, like what is the end amount?
And as you say, Paul, they're minimal amounts in terms of their hundreds, but there's so many of them coming at us, they all add up. Corporation tax, we're known worldwide for low rates of corporation tax, and I know that the European Union are certainly putting us under an awful lot of pressure to increase those and bring them up in line with other OECD countries. What did the budget have in store for corporation tax this year, Jim?
Again, maybe you could call it a good news story. I think our whole economy is dependent on a 12.5% rate of tax. I think if they touch this 12.5% rate of tax, I think they're effectively going to put the economy out of business. So I don't think they had any option here, really. They have kept it, and I think they had to keep it, and they're going to have to resist whoever comes after them when it comes to corporation tax, because it's the only thing that, one of the main things that keeps the foreign direct investment coming into Ireland, and that is one of the only good news stories we have across the economy, is that our exports are growing, and that's largely driven by multinationals who are investing and setting up in Ireland, which is continuing. So yes, corporation tax has been kept at 12.5%, and that is extremely welcome.
Just on the start-up situation, for those considering starting a business, there is a tax exemption. Paul, how does that work?
If a person is starting a business, the first thing obviously they have to figure out is what's the structure of that business. Is it a sole trader? Is it a partnership, or is it a company? If a person is starting up in a company, there's a number of reliefs available to them. There's a 3-year relief for the startup, which means that if you're starting up a business and you don't have any, and you make profit in that business for the first 3 years, you don't pay the tax. Now there is limits on it, but I'd say the majority of people are not going to pay any tax. They've also extended this 3 years relief for startups. And you can carry the losses forward, which is good news. If you have a business and you're trying to get it up and running, I would suggest that you seriously look at incorporating your business. The other thing as well with a start-up business, a lot of people have real good ideas and they're starting up and the enthusiasm is there to start up. But if you actually take a step back and plan that properly, the R&D tax credit provides a 25% tax credit for a business. Now, people ask, sure, I'm doing this or that and I might not necessarily be entitled to it. Take advice. If you're not entitled to it, you've lost nothing. If you are entitled to it, you should sit down and actually read through. There's a lot of information out there. There's a lot of information online. There's a lot of qualified people you can come and talk to in connection with this R&D tax credit. But I would encourage everybody to actually see what research and development, if any, they're doing in their business. There is another small change in connection with the overall corporation tax, and that's to do with if you have what's called a closed company surcharge. So if you're receiving non-earned income in your company, for instance, dividend income or deposit interest, they've changed the limits on that from 635 to 2,000. It affects a very small number of people, but it is a welcome increase for people that are receiving some deposit interest or some rental income within their company.
Just on the topic of rental income, this budget has seen the introduction of a real estate investment trust. What way does that work and what's it all about, Paul?
Well, the REIT, or the Real Estate Investment Trust, is an internationally recognised model for people investing in property. I think personally it's to allow the bigger investments that are out there and people to come together to actually to fund these bigger investments through what's called a REIT.
They have brought in this Real Estate Investment Trust, REIT. It's a structure that allows people to come together to invest in property. So I would agree with what Paul is saying. It's a model which just facilitates and makes it easier for groups of people to come together to invest in a property, and it's done through this particular trust structure that makes it easy for people to get in and out of the structure, really. So it facilitates larger property investments.
And what prompted the government to set up this trust, in your opinion, Jim?
It certainly doesn't seem to be something that's driven by the normal small investor. From what I can figure out, I would imagine it's designed to facilitate larger investors coming together to perhaps buy some of the larger investments, maybe a lot of the NAMA stuff that's going to come onto the market, or a lot of the larger office blocks that are available in Dublin and in other major centres. I think it's really designed at very large investors, principally, but we will have to wait until we see exactly what they're talking about. when it comes to this. Now, it will help, I think, to facilitate some property investment. And I would hope that it will allow banks and make it easier for banks to be able to loan money to these investment trusts, and that there might be a structure contained within it that will make it easier for banks and allow banks to be more comfortable, let's say, to loan money for property investment.
We see in this year's budget that the Employment and Investment Incentive Scheme has been extended from 2014 to 2020, Jim. Explain to our listeners what that's all about.
Well, Karl, this is the new name really for what was already there, called the Business Expansion Scheme, BES. So the whole idea of this scheme, and this scheme now, don't forget, and we must remember, is one of the main new areas that the government is promoting as to how they're helping businesses to grow and facilitating investment into businesses. So the idea is that anybody now can invest money in a qualifying company to allow that company to grow its business. And the person who invests money into that company, the investor, will get tax relief on the money that they're investing into the company. So it's under the BES scheme. It was the scheme was run over a 5-year time frame. Under the Employment and Investment Incentive Scheme, it's been run over a 3-year time frame. So you get your tax relief quicker, is the idea. So what they've done in the budget, the change they've made, is that they've extended this scheme from 2014 up to 2020. Now, I will say that I don't really believe that this scheme has been having any meaningful impact on the economy or on businesses. You have to get approval. You have to qualify to be if you want your company to receive investment, you have to go through a qualification process for it, and then you have to go find the investors. So even though the government are flagging it as quite a major scheme, it's in effect, I don't see it having any meaningful impact on employment and really on investment into business.
So it's more of a token gesture than anything else more meaningful than that, Jim?
Well, my concern about it is that the government are coming up with schemes and coming up with ideas and promoting ideas that are designed to increase employment and designed to allow businesses to grow. And for me, this is not something that's effective. That's my concern, really. It's just not effective. So I think there are easier and simpler ways that you could incentivise growth and incentivise employment. So that's my concern about it.
From a VAT perspective, VAT is always a bone of contention for businesses. What did this year's budget bring in relation to VAT?
On the VAT side, no changes to the VAT rate, and the high rate still stays at 23%. There has been a change that the threshold for accounting for VAT has been increased from 1 million to 1.25 million from the 1st of May 2013. Now, what that means is that you're not obliged to move onto the invoice basis of VAT and now until you go above a turnover of 1.25 million. So that is a bit of a change, but no change to VAT rates. You know, one welcome area is that the 9% rate of tax, VAT, is being kept for the tourism sector. So that's very welcome for restaurants and tourism-related businesses.
This year's budget was very kind to them in that it's providing them with a rebate on excise duty on fuel. Tell me a bit about that.
Well, the introduction for the hauliers, obviously, one of the big things is that there's no increase in the cost of fuel. You know, the petrol or diesel didn't go up. However, they've brought in an excise duty rebate. More will be known about it, you know, how the operation of it when it's brought in, but it's a massive welcome relief, you know, for hauliers to be able to claim back the excise duty.
And when is that coming in from?
I think it's the 1st of July, Karl, 2013.
Now, the Irish Road Haulage Association have been lobbying the government hard in relation to this over the last number of years. It seems that they've been successful in the end in relation to achieving this saving for hauliers, because fuel costs are certainly the biggest cost that they have to run their businesses on an ongoing basis.
Absolutely. I mean, they're a sector that are vital to this economy. We are an island. You know, everything moves in this country moves with the haulage. So everything that's delivered, everything that's brought has to be brought by haulage. So, I mean, it's a sector that's not properly looked after. So I think this is very welcome, and they should try to do as much more as possible with the haulage. I think the other thing is that obviously to claim back this, each haulier has to be tax compliant. I mean, that's one of the specific things that they mentioned in this to claim your excise, Joey. But that's good. I mean, you know, if they're tax compliant, they'll get their rebate.
There was some positive news for farmers also in this year's budget, Jim. Firstly, let's talk about stock relief. What were the changes brought about by this year's budget in relation to that?
Yes, Karl. The stock relief at 25% has been extended for a further 3 years to 2015. So that's fantastic to encourage young farmers. Young trained farmer stock relief of 100% is also extended for another 3 years up to 2015. So an encouragement there for young people to get involved in farming, which is happening more and more. And also there has been a change to an extension to the registered farm partnerships for the purpose of the 50% rate of stock relief. So they are certainly they're still encouraging people to stay in farming, encouraging young people to get into farming.
That's certainly very encouraging news for the farming community across the county, Jim. What changes are being brought about to relief for farm restructuring?
Yes, they are facilitating farm restructuring where perhaps parents are looking to hand over farm assets and farmland to their children. So to enable that, they're giving a relief from capital gains tax where the proceeds of the sale of farmland are reinvested for the same purpose. So that's a great restructuring relief. And so yes, they are facilitating that, and they're making it easier to transfer farmland.
And finally, in relation to farmers, we've seen in this year's budget a reduction in the farmers' flat rate. What impact is that going to have on the ground?
The government in this budget have signalled that they are supportive of the farming sector, and that's really very understandable because it employs a lot of people. It's a growing sector. There is a huge realisation that food is a great growth area for this economy, and that we're building up an international brand when it comes to food. So this has been recognised in this budget. That's the way I would read it. There's also a welcome reduction in the flat rate VAT relating to farms from 5.2% to 4.8%, and that comes in on the 1st of January 2013. So yes, the government are demonstrating their support not only for farming, I think, here, but also for the food sector.
Next, I'd like to focus on capital taxation, and maybe to start off on the capital gains tax. Paul, what has been the change in this year's budget, and has it been good or bad?
First of all, the capital taxes covered really would be capital gains tax and capital acquisitions tax. The rate has increased to 33%, which applies to any disposals made after the 5th of December. Which means if you've made a gain on a disposal, you now pay tax at 33%. In a way, I can see, I mean, putting the tax rate up to 33%, there's not that much capital, you know, the impact of that on the government and the tax take they're going to go on that, I can't see has been massively significant. The capital acquisitions tax has also moved to 33%. This applies to all gifts or inheritance that a person receives it. This is a tax that people should actually absolutely be sitting down to plan for. A parent that has built up, or somebody that has built up a pot of money or built up an estate worth money, in nearly all circumstances now, there's going to be a tax take on debt. People are not aware of it, they don't plan for it, they leave it there. The thresholds are being eaten away the whole time. The thresholds again this year have been reduced by 10%. And that also applies to anything from the 5th of December 2012. So the only thing I'll say to you with regards to that is go talk to your solicitor, go talk to your accountant, but talk to somebody who deals with capital acquisition tax and just get an idea of what the liability is potentially there for you. Imagine the circumstance where somebody passes away and the stress that causes within the family, but to go to administer the estate, and the next thing, it's all asset rich. So when they go to administer the estate, the next thing, there's a tax bill that has to be paid. and they weren't aware of it. And in this economy, you can't go to a bank now and borrow money to pay your tax bill. You know, they're not going to do that. So it's there. It's been reduced quietly. There's not a lot to talk about, but I think it could have a very serious impact going forward.
Capital taxes have certainly been focused upon by the government very, very harshly over the last number of years. I can remember only a couple of years back when both of those taxes were as low as 20%. So they've seen, over a 50% increase over the last 3 or 4 years, Jim.
Just to follow up on what Paul has said there, I think that this is the increase in the rate of capital gains tax to 33% from 30%, following on, as you've said, from 20%. This could be one of those ones now that could be counterproductive from the government's point of view. Because, again, where's the incentive to invest? And we saw a number of years ago where they reduced capital gains tax down to 20%. The tax take from capital taxes and from capital gains tax jumped because people were prepared to transact capital transactions. So I am concerned in an environment where we need people to invest, where we need people to take them to take risk. And that this could be counterproductive. I don't think it's going to net them much extra money, that's for sure.
Well, if you're in a position that you have a property and that you have a gain on it, or you have an asset that you want to sell that there's a gain on it, but you're now realising that instead of a 20% tax, you now have a 33%. I mean, that's huge. Like that, the cash flow implication to that to somebody, to me, would be a disincentive to sell.
Pensions, again, they got a lot of focus in this year's budget, Paul. Tell me more about this.
Well, pensions is it's an area that people are very, very worried about, because I said people are trying to plan for their future and protect and plan for their retirement. I mean, the idea of, as I said again, and I'll probably repeat myself, but the idea of selling a property years ago to liquidate, to get cash for your retirement, is now not possible. So the biggest way, or the biggest opportunity to have is to save within their pension fund. A very, very welcome relief is that tax relief has stayed at the marginal rate. That's a huge bonus. The other bonus would be that the pension levy is of 0.6% is now being withdrawn with effect from 2014. That's a decision that you have to actually really applaud the government. That's foresight. I think that's forward thinking. I think it's good. I think the idea to plan, to help people to plan for their retirement, is going to have a big impact in the long term. Because this, like, if we look forward, which is what everybody wants to do here, when we look forward, we know that at the other end of this, the more money we can get into our pension fund, and the more money we can protect ourselves for saving for the future, it's all going to be beneficial to the country. There is this thing about the 60,000 per annum, and my understanding of that is that will take effect from January 2014. But it's to do with the amount of money that you can put into your pension, my understanding, and the income that's made from that. So if you have €1 million in your pension fund and you're getting a return of 6% on that, then you're maxed. So there's a lot of understanding a lot of reading has to be done on this, and there's a lot of work still has to be done to actually completely understand it. The other thing they did do was they allowed people access to 30% of their pension fund through the AVCs.
Sorry, what's the AVCs, Paul?
So the additional voluntary contribution. A lot of people would you can access 30% of your fund once off. It's taxable when you take it out at the marginal rate. However, for the business person and the employer and the SME economy, I don't think it's going to be a massive impact, but I think it's going to have an impact on the public service. A lot of them can access now 30% because the methodology that they use would be to put money into their pension through the AVCs as well. So it's a little bit of a misnomer to think that the normal business person is going to be able to access their pension fund. That's not the case.
So all in all, Paul, it's good news for pensions, for self-employed people across County Wexford. Based on what initiatives have been brought about by this year's budget, what advice would you give to business owners planning for their own retirement across the county?
I think there's nothing better than a business owner can do is to sit down and plan. And planning across all areas of their business. Number one, financial planning is... If they only take one thing to do your financial planning properly, when you mention the word pensions, a lot of people turn off. But you're talking about savings and you're talking about investing. And saving within a pension structure is a very good, with tax rates going up, with USC being applied, with PRSI being applied, all of those issues, you save within your pension fund. The gains within your pension fund, if you have a property in your pension fund and you sell it within the pension fund, there's no tax until exit. So it is a good tax planning mechanism as well as good financial advice. You cannot beat it. So go to somebody, there's loads of good financial advisors around the place. There's loads of good accountants around the place who sit down and actually deal with financial planning properly. But when you put the money in, you then have to decide how you're going to invest it.
So the tax incentives that have been there for the last number of years remain to be in place, which is good news for the pension sector.
Yes, it's good news. Well, it's more so good news for the person. So the SME, it's good news for the business person. It's good news for us all. It's not necessarily just good news for the pension sector.
It looks like vintners have been hit hard in this year's budget, Jim. Tell me about this.
Yeah, well, already hard hit publicans are taking another hit here. The pint of beer or cider and a standard measure of spirits has been increased by 10 cent. Including VAT. This is an increase in excise duty, so drink will increase in the pub. If you're more inclined to drink at home with a bottle of wine, well, that's going up as well. It's going up by €1 per standard bottle. So yes, the publicans have taken another hit here. They're a hard hit sector. They're struggling, is what we are finding on the ground, and this is another difficult one for them.
It's an easy target for the government, though. Every year you see both alcohol and tobacco products affected. On the tobacco side, what's the impact out of this year's budget?
Well, we're talking 10 cents on a pack of 20 cigarettes, and of course those people again that have tried to make smoking a little bit cheaper by rolling their own, well, they're catching them now a bit as well. 50 cent extra for a 25 gram pouch. So smokers have been hit, and I suppose they're an easy target area, as you say, and haven't been touched now for a number of years. So the drinkers and the smokers are back on the agenda.
And in relation to motor tax, most companies across County Wexford will have a number of vehicles under their control. Motor tax is a direct tax on all vehicles. What impact has this year's budget had on that, Paul?
Well, motor tax across all categories is being increased with effect from the start of January. So it's another cost. We talked earlier about the hauliers and about the excise duty and all of that, but they all have to tax their vehicles as well. So it's a kind of a give it in one hand and take it back in the other in a way. And it was always going to be obvious that if they didn't increase the price of fuel at the pumps, they were going to increase the motor tax. So I think it's another easy target, and it's a stealth tax, but it affects everybody, because every family and everybody is driving. Now they have to get to work. The cost of going to work now. One of the employees we had said, I said, what is your biggest effect in the budget? She said, I'm so glad they didn't put up the price of petrol. She said, because it's getting so expensive just to go to work.
Now, finally, in relation to charitable donations, lots of companies across the county do certainly, through their own corporate social responsibility policies, give donations, and certainly, business people across the county are contacted, if not weekly, daily, and if not daily, weekly, in relation to making donations to charities. What incentive is there for businesses today to make a donation to a charity? Well, if you make a donation to a charity, you get tax relief on it. The charity has to be a registered charity, and the donation has to be over €250. They're changing the tax relief on the charitable donations to a blended rate of 31%. So if I have a charity and I am receiving donations off an individual, if they will give me their tax details, I can claim back the tax as a charity. That's a lot of charities are actually using this method, but the big problem they have is that people won't give them their tax details to actually claim the money back, so they're losing it. So they're changing it to a blended rate of 31%. So the 31% is the tax relief now on charitable donations. But more about that would come in, and how to actually go about it will come in with the bill. And my final question for both of you this morning is in relation to your overall assessment of the budget itself. Is it pro-business or not? Starting with yourself, Jim.
I'm not a big fan of this budget. it has really been a austerity in a very serious way. I don't think it's pro-employment. I think one impact is going to be for certain people on social welfare who want to work. For some of those people, it's going to make it more difficult to take a job because of the increase of €5 per week on PRSI on wages. So that's one aspect I'm not happy about. I don't see any great incentive for small businesses or employers to take on more workers, which was one of the big things I was looking for in this budget. So nothing that I see as being effective in that regard. I suppose the biggest concern I have overall is that I think that it's taking a huge amount of money out of our economy. And it's taking that money and it's not putting it to productive uses. And what I mean by that is that a lot of this money is going to service debts and mistakes of the past and paying bondholders and debts and things like that. So I think that money going out of the economy means that it's going to suppress our domestic economy. And I think that's really bad news for consumer confidence. I think it's bad news for our local economy. We are very depending on services and areas like retail. So consumer confidence is not going to get any lift here today. And so that is my big concern. There's no incentive. There's no way for me to believe that we're going to get any meaningful economic growth as a result of this budget. And that's a real concern.
Okay, so they've certainly broadened the tax base in relation to collecting more taxes from people, in a lot of cases in minimal amounts, but certainly they've done a lot to broaden the base. And as far as you're concerned, Jim, most of the measures have been of a token nature for businesses, but nothing significant. Paul, if I put the same question to you.
I think that there's some very good aspects to the budget. I think obviously we've talked about the pensions and there is some really good points to the budget, but there's also, to me, it's how do we actually stimulate growth within the economy? If everything we can talk about can be on a negative basis, but if we can stimulate the growth in the economy, that's going to drive it. I mean, all the SMEs around that we deal with, they're working hard, they're doing their little bit, and they're looking after their own little patch. But again, there's money coming out. So if we can generate growth, I think going forward, I think it's going to help us to drive the economy forward. I don't envy the politicians. That's been truthful with you. I don't know. I mean, it's an incredibly difficult job that they're in to try and balance this thing. You know, I can sit here and I can say that I think that they could have done this, that, or the other. But from a business point of view, is there lost opportunity there? Yes, there probably is lost opportunity. But this is where we are. This is where we are now. The budget has been done. Another budget has done. The finance bill has to come out and the Finance Act has to be passed. There will be changes between what's been announced and what actually gets enacted. So all I can say for the business people is plan, sit down and figure out what you're going to do and plan in every aspect of your business. Make sure you have a good sales plan in place, make sure you have a good financial plan in place, and make sure you have a good tax plan in place, and keep going forward.
Jim Doyle, Paul Redmond, I'd like to take this opportunity to thank you for coming in and speaking to our listeners this morning, and wish you continued success with RDA Accountants.
You're listening to South East Radio's Business Matters with Karl Fitzpatrick in association with Wexford Insurances. Think Wexford Insurances for your business insurance.